They told you dividends were safe. They told you dividends were passive. They told you dividends were the gentleman's way to build wealth, slow, steady, dignified. They handed you pamphlets with pictures of retired couples on sailboats, and they said, "Put your money in dividend stocks, collect your check, relax." And millions of people believed them. Millions of people parked their savings into high-yield dividend traps, watched those stocks bleed value for a decade, cashed their quarterly checks like grateful tenants paying rent on their own money, and called it a strategy. This book is not for those people. This book is for the ones who looked at the dividend investing world and felt something was off, something underneath the surface, something the financial media never talks about because the financial media is owned by the same institutions that profit from your obedience. My name does not matter. What matters is what I am about to hand you. I have spent years inside the machinery of dividend investing, studying it, stress testing it, breaking it down component by component until I understood not just how it works, but how it can be made to work harder, faster, and more ruthlessly than any traditional dividend investor would dare to attempt. What I discovered changed everything. There is a dark side to dividend investing. Not dark in the sense of illegal, not dark in the sense of reckless, dark in the sense that it is hidden, deliberately hidden. Because the moment you understand what dividends actually are, the moment you strip away the marketing language and the retirement fantasy, you stop being a passive income collector and you start being something else entirely. You start being a predator. The strategy in this book is called Kill Dividend. And before you finish this introduction, you are going to understand exactly why it carries that name. A dividend is not a gift. A dividend is not free money falling from the sky into your account. A dividend is a forced extraction of value from a company's stock price. The moment a dividend is paid, the stock drops by exactly that amount. You are not gaining, you are simply receiving back a portion of what you already owned in a different form, through a transaction that may trigger taxes you never consented to at a time you had no say in, reducing the compounding power of your capital without your permission. You have been taught to celebrate the thing that is quietly killing your returns. And the truly devastating part, you do not have to accept it. You have a choice. You have a weapon. And in the next 10 chapters, I am going to place that weapon in your hands, teach you exactly how to use it, and show you how to extract maximum profit from dividend-paying stocks without ever letting the dividend mechanic work against you again. This is Kill Dividend. This is max profit, no limit. Let us begin. Chapter 1. The Dividend Illusion. Let us start with a thought experiment. Imagine you have a $100 bill. You fold it in half, tear it down the middle, and put $50 in your left pocket and $50 in your right pocket. You reach into your left pocket, pull out the 50, hold it up, and say to yourself, "I just made $50. You did not make $50. You simply moved $50 from one pocket to another. This is what a dividend is. When a company declares a dividend, the moment that dividend is paid out to shareholders, the stock price of that company is reduced by exactly the amount of the dividend paid. This is not a theory. This is not a speculation. This is accounting reality, observable in the market on every single ex-dividend date, across every single dividend-paying stock, in every single market in the world. The phenomenon is called the ex-dividend drop, and it is the foundational truth upon which this entire book is built. On the day a stock goes ex-dividend, meaning the day by which you must own the stock to receive the upcoming dividend payment, the stock's price opens lower by the dividend amount. If a company pays a $1 quarterly dividend and the stock closed yesterday at $50, it opens this morning at $49. You receive $1 in cash. Your stock is now worth $1 less. Your total position value has not changed. You have moved money from your left pocket to your right pocket. Now, a standard financial advisor will tell you this is fine, that over time, the dividend payments compound, the stock recovers, and the total return justifies the strategy. And in some narrow, carefully selected scenarios, they are not entirely wrong, but they are selectively, dangerously incomplete. Because what they do not tell you is the full cost of receiving that dividend. First, there is the tax cost. In most jurisdictions, dividend payments are taxable income in the year they are received, even if you immediately reinvest them. If you are in a high tax bracket, a substantial portion of every dividend you receive goes directly to the government before you ever get to reinvest it. This breaks the compounding cycle. Capital gains, by contrast, are only realized and taxed when you choose to sell, giving you full control over the timing and therefore over your tax liability. Second, there is the opportunity cost. The capital that the company pays out as dividends is capital that is no longer inside the business. Capital that could have been used for research and development, for acquisitions, for expansion, for share buybacks, for debt reduction, all of which would have increased the intrinsic value of the company and therefore the value of your shares. When a company chooses to pay a dividend instead of reinvesting in its own growth, it is making a statement about its ability to find productive uses for that capital, and that statement is not always a flattering one. Third, there is the behavioral cost. High dividend yields attract a certain type of investor, the income-dependent investor, the retiree, the person who needs the quarterly check to pay bills. This creates artificial price support for stocks at valuations that may not be justified by their underlying fundamentals. When dividend cuts happen, and they do happen, often without warning, the sell-off among income-dependent investors is savage and fast. The stock collapses not because the business is destroyed, but because the investor base that propped it up has a reason to leave all at once. High yield, in many cases, is not a sign of generosity. It is a warning sign. It is the market telling you that investors have already priced in significant risk. A stock yielding 8, 9, or 10% in a market where treasury bonds yield 4 or 5% is not offering you a gift. It is offering you a puzzle. And the answer to that puzzle is almost always one of two things. Either the business is in decline and the dividend is about to be cut, or the stock price has fallen so dramatically that the dividend yield looks high, even though the underlying payment has not changed. Both of these scenarios are traps. This is the dividend illusion, the appearance of income masking the reality of value destruction, the psychological comfort of a quarterly deposit masking the structural erosion of your portfolio's compounding engine. To kill dividend does not mean to avoid dividend-paying companies. It means to understand the mechanics so completely that you are never manipulated by the illusion again. It means to extract from the dividend ecosystem only what serves your wealth-building goal and to surgically remove everything that works against it. Understanding the illusion is step 1, and you have just taken it. Chapter 2: The Anatomy of a Dividend Trap. Not all dividend stocks are traps, but the traps that exist are perfectly designed to look like the safest investments in the room. They have long histories, they have brand names you recognize, they have management teams that speak with calm confidence on earnings calls. They appear in every list of best dividend stocks for retirement. And they destroy capital slowly, invisibly, over years and decades, while the investor sits back collecting checks, telling themselves everything is fine because the income never stopped. Let me describe the anatomy of a dividend trap with precision so that you will never step into one again. The first component of a dividend trap is the payout ratio problem. The payout ratio is the percentage of a company's earnings that it pays out as dividends. A company earning $2 per share and paying out $1 per share has a 50% payout ratio. This is generally considered healthy. The company retains enough earnings to reinvest in the business while still rewarding shareholders. But many high-yield dividend stocks have payout ratios above 80%. Some have payout ratios above 100%, meaning they are paying out more in dividends than they are earning. They are funding the dividend through debt, through asset sales, through financial engineering that cannot be sustained indefinitely, and investors, seduced by the yield, do not look at the payout ratio. They see the yield and they buy. When the dividend is eventually cut, because mathematics always wins, the stock collapses, the income disappears, and the investor is left holding a position worth a fraction of what they paid, with no income to compensate for the capital loss. The second component is yield chasing. There is a specific type of investor, and the financial industry knows this type intimately, who makes investment decisions based almost entirely on yield. Give them a stock with a 6% yield, and they will buy it without reading a single page of the annual report. The financial industry has built entire product categories to serve this investor: REITs, MLPs, closed-end funds, preferred stocks, covered call ETFs, all of them designed around the psychological appeal of visible, consistent income. Some of these products are excellent. Many of them are sophisticated income extraction mechanisms that benefit the fund manager far more than the investor. The third component is the dividend aristocrat myth. There is a widely promoted concept called the dividend aristocrats, a list of companies that have increased their dividend for at least 25 consecutive years. These companies are presented as the pinnacle of dividend investing: safe, reliable, proven. And it is true that many of them are well-run businesses with genuine competitive advantages. But the dividend aristocrat label creates a perverse incentive. Management teams become obsessed with maintaining the streak, not because it serves shareholders, but because it serves the stock price, which serves management compensation. Companies have taken on significant debt to maintain dividend increases during periods of poor earnings. Companies have cut investment in growth stage businesses to protect the dividend. The streak becomes the goal, instead of being a natural byproduct of a healthy, growing business. When you invest in a dividend aristocrat solely because of the streak, you are investing in a brand, not a business. The fourth component is the income dependency cycle. Many individual investors in dividend stocks are retirees or near retirees who depend on the income for living expenses. This is not irrational. It is a legitimate strategy for certain life stages, but it creates a dangerous rigidity. When a holding underperforms, when the business deteriorates, when the sector turns hostile, when a better opportunity emerges elsewhere, the income-dependent investor cannot sell. They need the income, so they hold, and they hold, and they hold, long past the point where rational analysis would have told them to exit. This is the golden handcuff of dividend investing. The income feels so reliable, so regular, so real, that it chains the investor to a position even as the underlying value erodes. Kill Dividend breaks these chains. Kill Dividend says, you are not dependent on any single company's willingness to pay you a quarterly check. You create your own income on your own terms. You decide when to take liquidity from a position. You control the timing, the amount, and the tax treatment. The dividend does not control you. In the next chapter, we go even deeper into the actual mechanics of where dividend money comes from, who it really serves, and what the most sophisticated investors in the world actually do with dividend-paying stocks. Chapter 3: Blood Money, where dividends actually come from. I want you to think about where the money in a dividend payment actually originates. It is not created by the act of declaring a dividend. It existed before the dividend was declared. It was inside the company, in its cash reserves, in its balance sheet, in the accumulated retained earnings of years or decades of business operations. When the board votes to pay a dividend, they are not creating value. They are redistributing value that already existed. They are choosing to move capital from inside the company to outside the company, from the corporate balance sheet to your personal brokerage account. This sounds simple. It has profound implications that most investors never fully absorb. Let us trace the full journey of a dividend dollar. A company earns revenue. From that revenue, it pays operating costs, employee salaries, taxes, interest on debt. What remains is net income. From net income, the board decides to retain a portion for reinvestment and distribute a portion as dividends. The dividend is declared. The stock goes ex-dividend. The stock price drops. The cash hits your account. At each stage of this process, there are value leakages. Corporate taxes reduce the earnings before the dividend is even declared. If the company is financing the dividend through debt, which many do, there is interest cost eating into future earnings. Then, when the dividend hits your account, you owe income tax on it in most jurisdictions. In the United States, qualified dividends are taxed at capital gains rates, but non-qualified dividends are taxed as ordinary income. In many other countries, dividend withholding taxes apply, meaning if you hold foreign dividend-paying stocks, a portion of every dividend payment is withheld at source, and recovering it requires filing additional paperwork, and sometimes you never recover it at all. By the time a dividend dollar travels from the company's earnings through the declaration, payment, and taxation process and arrives as usable capital in your hands, it may have lost 20, 30, or even 40% of its original value to various friction costs. Capital that was never paid as a dividend, capital that remained inside a high-quality business, compounding at the business's internal rate of return, never suffers this attrition. This is the core mathematical argument against income-oriented dividend investing in growth-oriented portfolios. The compounding engine inside a great business is almost always more powerful than the compounding engine you can build by reinvesting dividend payments, because the business does not pay tax on its retained earnings before reinvesting them, and because the business has access to proprietary opportunities, internal growth projects, acquisitions, intellectual property development that you, as an external investor, cannot replicate. Warren Buffett has almost never paid a dividend through Berkshire Hathaway. He has explicitly stated why: because every dollar retained inside Berkshire, deployed by his capital allocation discipline, creates more than $1 of market value. The moment that dollar leaves Berkshire as a dividend, it loses the tax shield and the compounding power of internal deployment. Buffett is not being stingy. He is being mathematically precise. This is what the blood money argument reveals: that dividend payments are, in many cases, the involuntary liquidation of your ownership stake in a business's retained earning power. The company is forced, either by investor expectation, by index requirements, or by management's inability to find productive internal uses for capital, to return money to you in the least tax-efficient way possible. Now, and this is critical, this does not mean all dividends are destructive. There are businesses where the internal opportunities genuinely do not justify retaining all earnings. Mature utilities, infrastructure companies, established consumer staples with limited reinvestment potential. For these businesses, paying dividends is the honest and correct capital allocation decision. The cash flow is real, the reinvestment opportunities are limited, and returning capital to shareholders makes fundamental sense. But even for these businesses, the kill dividend approach finds a way to take the best of what they offer while neutralizing the costs. Because the goal is never to avoid dividend companies entirely. The goal is to never be at the mercy of the dividend mechanic when your wealth-building strategy demands something different. In the chapters ahead, you will learn exactly how to be in the dividend market without being subject to its costs. You will learn how to extract yield on your terms. But first, you need to understand one more thing about where the real money in dividend investing actually goes, and it is not to individual investors. Chapter 4. The Dark Yield Formula. Every serious investor should have a formula, a mental model precise enough to guide decisions under uncertainty, flexible enough to adapt to different market conditions, and powerful enough to separate genuinely attractive dividend situations from the sophisticated traps that masquerade as them. I call this the dark yield formula. It is not a single equation. It is a multi-layer evaluation framework that looks at dividend-yielding assets through 5 simultaneous lenses, each lens filtering out a different category of risk and illusion, until what remains is a stripped-down, honest picture of what a dividend investment is actually worth. The first lens is the adjusted real yield. This is not the dividend yield printed on your brokerage platform. That number is unadjusted, pre-tax, and calculated on the current stock price, making it meaningless as a measure of actual return. The adjusted real yield begins with the stated dividend yield, then subtracts estimated tax drag based on the investor's marginal rate and dividend classification, then subtracts the annualized dividend dilution, the amount by which the stock price is structurally depressed as a result of regular ex-dividend price drops that do not fully recover, then subtracts the inflation erosion on the nominal payment. What remains is the true return you are receiving for the risk you are taking. In many high-yield scenarios, this calculation produces a result that is shockingly close to zero and sometimes negative. The second lens is the dividend coverage quality score. This is a composite assessment of how safely the dividend is covered by real, sustainable cash generation. It considers the free cash flow payout ratio, not the earnings payout ratio, because earnings can be manipulated while cash cannot. The trend of free cash flow generation over the past 5 years, the stability and predictability of the business model, the debt-to-EBITDA ratio, and the interest coverage ratio. A dividend that scores poorly on coverage quality is a dividend that exists today and may not exist tomorrow. Chasing it is not income. Investing it is speculation on a payment's survival. The third lens is the capital appreciation offset. This measures the degree to which the dividend yield is being paid at the expense of stock price performance. A stock yielding 5% that has delivered zero price appreciation over 5 years has actually underperformed a stock yielding 0% that has delivered 5% annualized price appreciation and the zero yield. Stock likely did so with lower tax drag. The capital appreciation offset forces the investor to compare the total return of the dividend investment against the total return of the best non-dividend alternative available at the same risk level. This comparison is rarely favorable for high-yield income stocks. The fourth lens is the sector headwind assessment. Dividend stocks are not uniformly distributed across all sectors. They are heavily concentrated in utilities, telecommunications, real estate, consumer staples, energy, and financial services. Each of these sectors carries its own structural headwinds: regulatory risk for utilities, technological disruption for telecoms, interest rate sensitivity for REITs, commodity price volatility for energy, and credit cycle exposure for financials. These structural headwinds affect stock prices over multi-year periods, and a sustained sector decline can overwhelm even the most generous dividend yield. The kill dividend investor does not ignore sector dynamics just because the quarterly income is arriving on schedule. The fifth lens is the management capital allocation record. This is perhaps the most important lens of all because it reveals intent. How has the management team actually deployed capital over the past decade? Have they used retained earnings to build genuine competitive advantage, or have they used them to prop up an increasingly fragile business? Have they raised the dividend sustainably, or have they sacrificed the balance sheet to maintain an impressive streak? Have they repurchased shares when the stock was cheap, or have they bought back shares near all-time highs to offset dilution from executive compensation programs? Management's capital allocation record tells you more about the long-term value of your dividend investment than any single financial metric. Run any dividend investment through all 5 lenses of the dark yield formula. Compare what you find to what the headline yield suggests. In the best cases, the formula will confirm that you have found something genuinely valuable, a business with real yield, secure coverage, competitive stock performance, favorable sector dynamics, and excellent capital stewardship. These investments exist. They are rare, but they exist. And when you find them, the kill dividend strategy tells you exactly how to maximize them. In the worst cases, the formula will show you what you almost bought, and that is perhaps its greatest value of all. Chapter 5. Kill the dividend trap, the exit doctrine. Knowing a trap exists is not the same as escaping it. Many investors understand, intellectually, that a particular dividend holding is problematic. The yield is high for the wrong reasons. The payout ratio is unsustainable. The sector is in structural decline. The management team is leveraging the balance sheet to maintain a dividend streak that serves their compensation plan more than it serves shareholders. They know, and they stay. They stay because the income has become embedded in their financial plan. They stay because selling means realizing a loss that they have not yet acknowledged on paper. They stay because the dividend, still arriving on schedule, provides psychological comfort even as the fundamental picture deteriorates. They stay because they have told their family, their friends, their financial advisor about this stock, and selling it means admitting they were wrong. The behavioral science behind dividend trap persistence is extraordinarily well documented. Loss aversion, the human tendency to feel losses approximately twice as powerfully as equivalent gains, keeps investors in deteriorating positions long after rational analysis would demand exit. The endowment effect, the tendency to overvalue things we already own simply because we own them, makes dividend investors assign excess worth to the income stream they are currently receiving, even as the stock beneath it collapses. Sunk cost fallacy. The irrational belief that past losses justify continued holding keeps money trapped in positions where the expected future return is poor, simply because the investor cannot emotionally separate the past from the future. Kill dividend begins with an exit doctrine. Before a single dollar enters a dividend position, the terms of exit are defined. The exit doctrine has 3 components. The first component is the dividend cut trigger. If the dividend is cut by any amount, the position is evaluated for exit within 48 hours. A dividend cut is not a small event. It is a signal from management that the business is generating less cash than expected, that the balance sheet requires protection, or that the future is more uncertain than the previous guidance implied. It is also a signal that the income-dependent investor base, the population propping up the stock price, is about to begin selling. The combination of reduced income appeal and deteriorating fundamentals typically produces sustained price weakness following a dividend cut. Being among the first to reevaluate, not necessarily the first to panic, but the first to think clearly, is a significant advantage. The second component is the fundamental deterioration trigger. If 2 consecutive quarters show meaningful deterioration in free cash flow per share, rising debt to EBITDA beyond a preset threshold, or revenue decline in the core business segment, the position is evaluated for exit, regardless of whether the dividend has been cut. This is anticipatory discipline. The dividend cut is a lagging indicator of fundamental deterioration. Management always defends the dividend longer than the fundamentals justify, because the stock price hit from a dividend cut is immediate and visible, while the damage from maintaining an unsustainable payout accrues slowly. Waiting for the dividend cut before evaluating exit means you are always reacting to yesterday's news. The third component is the opportunity cost trigger. Every position in a portfolio competes against every other possible deployment of that capital. If a dividend holding's total expected return, adjusted real yield, plus expected capital appreciation, minus tax costs, falls below the expected total return of an alternative investment with similar or lower risk, the position is a candidate for rotation. Most investors never apply this test because it requires the uncomfortable admission that holding a stock is an active decision, not a passive one. You are not holding a stock because you have to. You are choosing to hold it today, at its current price, against all alternatives available to you. Making that choice consciously, regularly, and with full information is one of the most powerful habits in the kill dividend system. The exit doctrine is not about trading frequently. It is about never being imprisoned by a position. It is the explicit, pre-committed framework that allows you to act on information instead of emotion, to move when the fundamentals demand it, before the crowd reaches the same conclusion. Freedom of movement is the foundation of maximum profit. You cannot extract maximum returns from a portfolio if the portfolio owns you. Chapter 6: The Reinvestment Weapon. Here is where the kill dividend strategy begins its most aggressive phase. We have established what dividends cost you. We have established how to identify the traps. We have established the discipline of exit. Now we build the machine, the actual wealth creation architecture that turns the dividend ecosystem into an engine of maximum, uncapped, compounding return. The reinvestment weapon is built on a single insight. The company's decision about what to do with its earnings is not necessarily the optimal decision for your wealth. You can disagree with that decision. You can route the capital differently, and when you do so systematically, with discipline and intelligence, you build compounding power that surpasses what passive dividend collection ever could have produced. The first component of the reinvestment weapon is synthetic dividend generation. In a high-quality, non-dividend paying growth stock, or in a low-yield stock where the dividend is minimal, you can create your own dividend on your own terms by periodically selling a small percentage of your position. This is called a homemade dividend or synthetic income strategy. If you own a stock worth $100,000 and want $5,000 of annual income from it, you sell 5% of your position at a time of your choosing, capturing the cash when you need it in the tax year that is most advantageous for you, at a price that reflects not an arbitrary ex-dividend date, but your own tactical assessment of the market. If the stock has appreciated significantly, your 5% sale captures both income and capital gain in a single transaction, at capital gains tax rates, with no forced timing. This is not a complicated strategy, but it requires psychological reframing, the willingness to accept that self-generated liquidity is superior to externally imposed dividend payments, even though it feels less passive and requires one additional decision per year. The second component is dividend capture optimization. For investors who do want to participate in dividend payments, there is a tactical approach that extracts the income while minimizing the time spent in the position. Dividend capture involves purchasing a stock shortly before the ex-dividend date, receiving the dividend, and selling after the price stabilizes. The theoretical argument against dividend capture is that the ex-dividend price drop eliminates the gain, but in practice, stocks do not always drop by the full dividend amount on the ex-dividend date, particularly in rising markets where general buying pressure offsets the mechanical downward adjustment. Skilled execution of dividend capture, applied selectively to high-quality stocks with liquid options markets, can generate income that approaches the stated dividend yield without requiring permanent exposure to the company's long-term fundamental risk. The third component is the covered call income engine. This is the most powerful tool in the reinvestment weapon arsenal and the one most frequently underutilized by individual investors. When you own shares of a dividend-paying stock, you can sell call options on those shares, collecting premium income that functions exactly like an additional dividend, but at rates often 2 to 4 times the stock's stated dividend yield on a monthly basis, with full control over the strike price and therefore over the upside you are willing to cap. A stock yielding 3% annually in dividends might generate an additional 6 to 12% annually in covered call premium income, paid monthly, taxable as short-term capital gains only upon the option's expiration or exercise. The combined yield dividend plus covered call premium can transform a moderate yield holding into a high-income machine without increasing the portfolio's exposure to capital loss. And if the stock is called away at the strike price, you have achieved a predetermined exit at a predetermined price, with the premium collected as guaranteed profit regardless of the outcome. The fourth component is dividend reinvestment acceleration. For investors using traditional DRIP programs, dividend reinvestment plans, the kill dividend approach supercharges the compounding effect by selectively concentrating reinvestment in moments of price weakness. Instead of automatically reinvesting every dividend at whatever price the stock trades on payment date, the disciplined investor accumulates dividend cash, monitors the stock price, and deploys the accumulated capital in larger quantities during temporary dips caused by market volatility, sector rotation, or short-term negative news. This transforms the passive DRIP into an active accumulation strategy, buying more shares per dollar during weakness and capturing the mean reversion premium that comes from systematic buying below intrinsic value. Together, these 4 components of the reinvestment weapon do something that no passive dividend strategy can replicate. They turn income generation into a conscious, controlled, optimized system rather than a reflex. And in investing, conscious and controlled always beats reflexive. Always. Chapter 7: Tax Warfare. There is a war being fought over your dividend income, and in most cases, you are losing it without knowing it has been declared. The war is between your wealth-building objective and the tax code. And the tax code, written largely under the influence of financial industry lobbying, is specifically designed to favor certain types of income events over others in ways that most individual investors never fully map out. Kill dividend approaches taxation not as an unavoidable friction cost, but as a battlefield where preparation and strategy generate measurable, recurring advantage. Let us start with the basics of dividend taxation in the United States, then expand outward to the global picture. In the United States, dividends are classified into 2 categories: qualified and non-qualified. Qualified dividends are taxed at long-term capital gains rates, 0% for investors in the lowest tax brackets, 15% for most middle-income investors, and 20% for the highest earners, with an additional 3.8% net investment income tax applying to higher-income investors on top of the capital gains rate. Non-qualified dividends, including dividends from REITs, most master limited partnerships, foreign companies, and short-term holdings, are taxed as ordinary income at rates up to 37% for the highest bracket. The spread between qualified dividend taxation and ordinary income taxation can reach 15 to 20 percentage points for high-income investors. This is not a minor distinction. On a large dividend income stream, The difference between qualified and non-qualified treatment can represent tens of thousands of dollars annually. Kill Dividend's first tax warfare principle is qualification management. Know which of your holdings pay qualified dividends and which do not. Understand the holding period requirements to receive qualified tax treatment. You must have held the stock for at least 61 days during the 121-day period, beginning 60 days before the ex-dividend date. Dividend capture strategies that involve rapid in and out trading will generate non-qualified income regardless of the dividend's inherent classification. Covered call strategies that cap upside below the strike price can also destroy dividend qualification depending on the strike price relative to the current price. Every tactical maneuver in the dividend space must be evaluated against its tax classification impact before execution. The second tax warfare principle is account location optimization. Not all investment accounts carry the same tax treatment. Tax-advantaged accounts, traditional IRAs, Roth IRAs, 401ks, health savings accounts, shield income, and capital gains from current taxation, either deferring them into the future or eliminating them entirely in the case of Roth accounts. Kill Dividend's account location strategy places high-yield, tax-inefficient dividend assets inside tax-advantaged accounts where their tax drag is neutralized. Meanwhile, lower-yield, capital appreciation-oriented assets, which generate most of their return through long-term capital gains that are already taxed preferentially, are held in taxable accounts where their tax advantage is fully realized. The practical impact of this location optimization is significant. A high-yield REIT generating 8% income annually, held in a Roth IRA, produces its full 8% return without tax friction, compounding to enormous values over long periods. The same REIT, held in a taxable account at a 37% ordinary income tax rate, effectively yields only about 5% after tax, a structural drag that compounds negatively over decades. The third tax warfare principle is loss harvesting integration. Every portfolio contains positions with unrealized losses at various points in the market cycle. The Kill Dividend investor uses these losses strategically, harvesting them to offset dividend income and capital gains, reducing the current year's tax liability, then reinvesting the proceeds in equivalent assets that maintain market exposure without the technical sale, creating a wash sale problem. Tax loss harvesting does not eliminate tax liability permanently. It defers it or converts it from ordinary income rates to capital gains rates. But deferral over decades, combined with the time value of money, creates real compounding benefit. The fourth tax warfare principle is the dividend elimination swap. For positions where dividend income is generating tax costs that exceed the income's strategic value, the Kill Dividend investor may choose to swap into a functionally equivalent position that does not pay dividends. This is the literal kill of the dividend, the substitution of a dividend-generating asset for a non-dividend-generating one with similar return characteristics, purely to eliminate an unwanted tax event. In practice, this is executed through asset class substitution, moving from a dividend ETF to a growth ETF with the same sector exposure, or from a dividend-paying stock to a Leaps call option that captures the same price movement without dividend exposure. The fifth tax warfare principle, the most advanced of all, is the option-based tax character conversion. Certain option strategies, when applied to dividend positions, can convert what would otherwise be ordinary dividend income into long-term capital gain at rates as much as 20 percentage points lower. These strategies are sophisticated and require careful execution within the boundaries of current tax law, and they must be reviewed with a qualified tax professional before implementation. But for large portfolios where dividend income represents a significant annual tax liability, the return on the time and resources invested in tax character conversion can be extraordinary. Tax warfare is not evasion. It is not aggressive shelter abuse. It is the disciplined application of knowledge about how the tax code actually works in service of the single governing principle of kill dividend, maximum profit, no limit. Chapter 8. The Dividend Aristocrat Massacre. Let us now confront the most sacred institution in dividend investing, the dividend aristocrat, and examine it with the unflinching honesty it deserves. The Dividend Aristocrat Index, maintained by S&P, tracks companies in the S&P 500 that have increased their annual dividend payment for at least 25 consecutive years. As of recent years, this list contains roughly 65 to 70 companies. They are presented as the most reliable, most consistent, most proven dividend payers in the American market, and their collective track record is frequently cited as evidence that dividend growth investing is the optimal long-term wealth-building strategy. Let me tell you what the track record actually shows, and then let me tell you what it hides. The Aristocrat Index has delivered solid, long-term returns. Over the past 30 years, the Aristocrat Index has roughly matched or modestly outperformed the broader S&P 500 on a total return basis, with somewhat lower volatility. If you had simply bought and held the Aristocrat Index for 3 decades, reinvesting all dividends, you would have done well. Not exceptionally well, but well, respectable. But here is what the 3-decade aggregate conceals. The Aristocrat list changes constantly. Companies that are on the list today may not have been on it 20 years ago, and companies that were on it 20 years ago may have been removed, either because they cut their dividend or because they left the index entirely, often because their business had deteriorated to the point where they no longer qualified. When you see the 30-year performance record of the Aristocrat Index, you are seeing survivorship bias data, a constructed portfolio that has been retroactively filled with the survivors, while the failures have been quietly removed. The companies that fell off the Aristocrat list over the past 3 decades include some genuinely catastrophic wealth destroyers. They include companies that maintained their dividend streaks through financial engineering until the moment they could not, and then collapsed spectacularly when the truth emerged. They include companies in industries that were disrupted by technology, by regulation, by global competition, companies whose management teams prioritized the dividend streak over genuine business adaptation until the business could no longer survive at all. The second thing the aristocrat mythology conceals is the valuation premium. Because the aristocrat brand is powerful, because the aristocrat list is widely tracked, because ETFs and mutual funds are constructed around it, aristocrat stocks often trade at premium valuations to the broader market. You are not buying these companies at fair value, you are paying extra for the brand, and that valuation premium reduces your forward return. A company with genuinely excellent fundamentals, trading at a significant multiple premium to intrinsic value, because it has been on a famous list for 2 decades, is a less attractive investment than an equally excellent company trading at a fair multiple with no branding premium attached. The third concealment is the sector concentration risk. The Aristocrat Index is heavily concentrated in consumer staples, healthcare, industrials, and financial services. These sectors have performed well over the past 3 decades. They may or may not perform equally well over the next 3. A world undergoing rapid technological transformation, energy transition, and demographic shift does not necessarily reward the same sector allocations that worked during the era of stable consumer demand and financial globalization. Anchoring a portfolio to aristocrat-style sector allocation because it worked historically is a form of investing in the rearview mirror. None of this is an argument that aristocrat companies are bad businesses. Many of them are excellent. The argument is that the aristocrat label itself, the streak, the brand, the index inclusion, creates price distortions, behavioral rigidities, and selection biases that reduce the return available to investors who could otherwise access the same businesses more intelligently. The kill dividend approach to aristocrat companies is precise. Identify the subset of aristocrat companies where the streak reflects genuine business strength rather than financial engineering. Evaluate their current valuation against intrinsic value without reference to the streak. Use the dark yield formula to determine whether the dividend income justifies the tax and opportunity costs in your specific portfolio context. Deploy the covered call income engine to enhance the yield beyond what the stated dividend delivers. And maintain exit doctrine discipline regardless of how many consecutive years the dividend has been raised, because the 26th consecutive increase does not make the 27th inevitable. The aristocrat is a story. The underlying business is what pays you. Know the difference. Chapter 9. Building the kill portfolio. Everything we have covered so far has been preparation. Every concept, every framework, every warning, every formula, it has all been building toward this moment. The construction of an actual portfolio using kill dividend principles. The kill portfolio is not a specific list of stocks. Markets change, valuations change, opportunities emerge and disappear. What the kill portfolio provides is an architecture, a structural framework that remains valid across market cycles, economic environments, and individual investor circumstances because it is built on principles rather than predictions. The kill portfolio operates on 3 simultaneous layers, each serving a distinct function within the overall system. The first layer is the core compounding layer. This layer holds 3 to 6 positions in the highest quality, most durable businesses that compound capital internally at exceptional rates. These are not necessarily dividend payers. They may pay no dividend at all. The qualification criteria are simple and strict. The business must have a demonstrable, sustainable competitive advantage that produces returns on invested capital above 15% over a full business cycle. The management team must have a proven record of intelligent capital allocation, and the valuation must be at or below intrinsic value as estimated through conservative discounted cash flow analysis. This layer is held with a long time horizon, 5 to 10 years minimum. It is never traded for tactical reasons. It is the wealth engine of the portfolio, the foundation on which everything else is built. Positions here are sized at 5 to 15% of total portfolio value each, and they are reviewed annually, not quarterly, not monthly. Annual reviews with pre-committed exit criteria prevent emotional decision-making and protect the compounding engine from unnecessary interruption. The second layer is the yield optimization layer. This layer holds 3 to 5 positions in dividend-paying companies that have passed the full dark yield formula evaluation, strong coverage quality, competitive real yield after tax, positive capital appreciation offset, favorable sector dynamics, and excellent management capital allocation record. These are not the highest yielding stocks available. They are the best yielding stocks available, a critically important distinction. Positions in this layer are enhanced with the covered call income engine, generating additional monthly premium on top of dividend yield, transforming moderate yield positions into high-income machines. Tax placement is carefully managed. The most tax-inefficient positions in this layer are held in tax-advantaged accounts. Exit doctrine triggers are predefined for every position. Position sizes are 3 to 8% of total portfolio value, reflecting the higher ongoing monitoring requirements relative to the core compounding layer. The third layer is the tactical opportunity layer. This is the smallest layer, representing no more than 10 to 15% of total portfolio value at any time, and it operates on the shortest time horizon. It captures specific, time-limited opportunities that do not fit the criteria of the first two layers, but meet a distinct standard of risk-adjusted attractiveness. This includes dividend capture trades on high-quality stocks with predictable ex-dividend price behavior, short-duration covered call positions on temporarily depressed high-quality companies, and special situation dividend investments, where a company is transitioning its capital return policy in a way that the market has not yet fully priced. Positions in the tactical layer are sized at 2 to 5% of total portfolio value and have hard exit timelines. They are not held open-endedly and cannot migrate into the other layers without satisfying those layers' separate qualification criteria. The KILL portfolio's overall construction principles are these: maximum position concentration in the highest conviction ideas. Diversification is not an end in itself, it is a risk management tool, and, like all tools, it can be misused. A portfolio of 60 dividend stocks is not 6 times safer than a portfolio of 10. It is 60 times harder to monitor and maintain, with diluted returns in the best ideas and unchecked deterioration risk in the forgotten ones. 10 to 15 total positions, held with complete understanding of each, is the KILL portfolio target. Continuous cash flow generation from multiple mechanisms. At any point, the KILL portfolio generates income from dividends in the yield optimization layer, from covered call premiums across multiple positions, and from selective liquidity events in the tactical layer. This multi-source income is structurally superior to single-source dividend income because it is not dependent on any single company's willingness to maintain a payout. Full tax architecture at the portfolio level. Every position is placed in the account type that maximizes its after-tax return. Every realized gain is paired with an analysis of available loss harvesting opportunities. Every income source is classified by tax character and managed accordingly. The KILL portfolio does not treat taxes as something that happens to it. It treats taxes as something it manages actively. Pre-committed behavioral protocols. Every position in every layer has a predefined review schedule, a predefined exit trigger framework, and a predefined maximum position size to prevent any single holding from becoming too psychologically entrenched to exit rationally. These protocols are written down. They are not held only in memory, where emotion can edit them invisibly. Quarterly rebalancing with purpose. The KILL portfolio rebalances not on a mechanical percentage schedule, but on a purpose-driven assessment, when the capital allocation between layers drifts materially from the strategic target, when a position has grown to a size that concentrates risk inappropriately, or when a compelling new opportunity in any layer demands capital that must come from an existing position's reduction. This is the architecture. This is the system. It is not a get-rich-quick scheme. It is not a passive set-and-forget vehicle. It is an active, intelligent, disciplined wealth-building machine built on the deepest understanding of what dividend investing actually is, and what it can become when the illusion is stripped away and the mechanics are deployed with precision. Chapter 10. Maximum Profit, No Limit. We have arrived at the final chapter, and it is time to speak about something that most financial books are afraid to address directly: the ceiling. Most investors operate under an invisible, self-imposed ceiling on their returns. They do not consciously set this ceiling. They absorb it from the financial culture around them, from advisors who talk about reasonable expectations, from media that treats double-digit annual returns as extraordinary, from a dividend investing orthodoxy that celebrates the collection of modest yield as the pinnacle of investing wisdom. KILL Dividend rejects the ceiling. Not because the laws of finance can be escaped, they cannot. Not because risk can be wished away, it cannot. But because the ceiling most investors operate under is not imposed by the laws of finance. It is imposed by the limits of their knowledge, the rigidity of their frameworks, and the comfort of convention. The maximum profit principle begins with a reframe. Ask not what return this asset can deliver. Ask what maximum return this asset class, this market environment, and your unique skill set and information advantage can produce, and then build toward that maximum with every decision. Let me describe what maximum profit actually looks like in practice across the dividend landscape. In the core compounding layer, maximum profit is achieved when you identify a great business before the broader market fully recognizes its greatness, hold it through its full compounding arc without interruption, and exit at the point of full valuation, not at a predetermined time target, not at a round number price target, but at the point where intrinsic value has been realized in the market price, and further holding offers less prospective return than the next best alternative. This requires patience of a depth that most investors cannot sustain. It requires the willingness to hold a position through drawdowns of 20, 30, 40%, trusting the underlying business quality rather than reacting to market noise. The investors who mastered this discipline did not achieve maximum profit by being smarter than everyone else. They achieved it by being more patient, more disciplined, and more honest with themselves about what they owned and why. In the yield optimization layer, maximum profit is achieved through the covered call income engine operating at peak efficiency call premium, maximized through intelligent strike selection, dividend income qualified and tax advantaged, positions compounded through active reinvestment during weakness, and exit executed when the combination of income and capital appreciation has fully realized the position's value. The combination of dividend yield and covered call premium, properly managed, can generate annual income returns in the range of 12 to 20% on capital deployed not consistently, not without risk, but as a realistic ceiling for skilled execution in this layer. In the tactical layer, maximum profit is achieved through disciplined repetition of high probability, short duration income opportunities, dividend capture, premium collection, special situations, each small by itself, but accumulating over time into a meaningful contribution to portfolio return, all generated from capital that is otherwise waiting for deployment in the higher conviction layers. But beyond the mechanics, maximum profit requires something that cannot be systematized: conviction. Conviction means acting on your analysis when the market disagrees with you. It means buying when the headlines are terrifying, holding when everyone says sell, exiting when everyone is celebrating. Conviction is not stubbornness. It is the product of thorough analysis, clearly defined principles, and the emotional discipline to distinguish between being wrong and being early. No limit means something specific. It means there is no arbitrary cap on what you are willing to learn, willing to adapt, willing to challenge. The investor who says I am a dividend investor and means it as a permanent identity is placing a limit on themselves. The kill dividend investor is not a dividend investor. They are a return investor, a capital allocator, a student of markets who happens to understand the dividend ecosystem with unusual depth and who uses that understanding as one of many tools in the pursuit of maximum return. No limit means reviewing your framework annually and discarding whatever has stopped working. It means reading outside your comfort zone, studying businesses in sectors you have never owned, learning option mechanics you have never used, exploring tax strategies you have never applied. The advantage compounds, the knowledge compounds, the discipline compounds, and all three compound faster than any dividend payment ever could. Now, let me leave you with this. Every day, Millions of investors receive their quarterly dividend payments. They open their brokerage apps, they see the cash, they feel the satisfaction of passive income, and they cannot see, because they have never been shown the full picture of what that payment cost them, what it prevented them from building, and what they could have had instead. You see it now. You see the ex-dividend drop. You see the tax drag. You see the compounding leak. You see the behavioral trap. You see the coverage fragility. You see the sector concentration. You see the management incentive distortion. You see the valuation premium on the famous lists. You see it all. And because you see it, you are free. You can take the dividend ecosystem with all its cash flows, all its volatility patterns, all its psychological quirks, all its pricing inefficiencies, and you can deploy it deliberately, surgically, on your terms, in service of your maximum return. The dividend does not control you. You control the dividend. That is what it means to kill dividend. That is maximum profit, no limit. This is where the average investor stops. This is where you begin. A final word on the philosophy. Before you close this book and step into the market with new eyes, I want to leave you with something that goes beyond strategy. Something about the philosophy underneath everything we have discussed, because the mechanics, as powerful as they are only as good as the mind operating them. Investing is not math. Investing looks like math. It is dressed in numbers and ratios and formulas and yield curves. But underneath all of that, investing is a test of character. Every position you hold is a daily vote of confidence in your own analysis, made against the pressure of market sentiment, media noise, social comparison, and the deeply human fear of being wrong in public. Most investors are not undone by bad analysis. They are undone by good analysis that they abandon under pressure. The kill dividend investor understands this at a foundational level. Every framework in this book, the dark yield formula, the exit doctrine, the reinvestment weapon, the tax warfare principles, the kill portfolio architecture, every one of them is designed not just to maximize return, but to protect the investor from themselves, to take the emotional ambiguity out of decisions that should be made rationally, to replace the question, "What do I feel like doing?" with the question, "What does my pre-committed system require of me right now?" This is the deepest form of investor discipline, not the discipline to study harder or research more, though those matter. The discipline to follow through on conclusions you have already reached, even when the market is screaming at you to abandon them. The investors who have built the greatest wealth in the history of financial markets are not the ones who were right the most often. They are the ones who acted on their rightness most consistently and most completely. They are the ones who, when they found a great business at a fair price with the full backing of their analytical framework, bought it without hesitation and held it without flinching. They are the ones who, when the market presented them with a beautiful-looking yield on a fundamentally broken business, walked away without regret. Kill dividend is ultimately about freedom. Financial freedom, yes, the obvious kind, the kind measured in portfolio value and income generation and compound returns over decades, but also a deeper freedom. Freedom from the narrative that slow and passive is the only responsible way to build wealth. Freedom from the income dependency that chains investors to deteriorating positions. Freedom from the marketing stories that financial institutions have constructed around dividend investing for their own benefit. Freedom from the invisible ceiling that convention places on your return potential. You now know how dividends are created and what they actually cost. You know how to identify the traps before they close around you. You know how to build a yield framework that reflects reality rather than headline numbers. You know how to generate income on your own terms. You know how to make taxation work in your direction rather than against you. You know how to build a portfolio architecture that generates maximum return across multiple simultaneous mechanisms. And you know how to sustain the behavioral discipline that makes all of it work in practice and not just on paper. What you do with this knowledge is entirely up to you. The market is open every trading day, every morning. The same companies that have been building value for decades open at a price. Some of them are priced fairly, some are priced too high. Occasionally, one is priced too low, and in that moment, for the investor who has done the work, the opportunity is real and the action is clear. Be ready for that moment. Build the system before you need it. Know what you own and why you own it. Define the terms on which you will exit before the emotion of a live market makes clear thinking impossible. Let the income work for you on your terms, in your time, at your optimal tax rate, not on the schedule of a board of directors you never elected and whose interests are not identical to yours. This is the final principle of Kill Dividend. Not just maximum profit as a destination, but maximum profit as a permanent orientation. A way of approaching every investment decision with the question, am I extracting the maximum return this opportunity can honestly deliver, or am I accepting less because it is comfortable, familiar, or endorsed by conventional wisdom? Never accept less. Not in this market, not with this knowledge, not anymore.